Okay, so you know how everyone's always talking about interest rates, right?
It's definitely a hot topic.
It feels like every time I turn on the news, it's Bank of Canada raises rates, and I'm like, okay, that's got to affect me somehow, but like,
Yeah.
how exactly?
Yeah, it can be a little confusing.
So that's what we're diving into today, how interest rates hit, well, home, like literally your house and your wallet. And luckily, we've got this great source from CIRO, the Canadian Investment Regulatory Organization, to kind of break it all down.
Yeah, their information is super useful as like a starting point
Yeah.
because a lot of people, they find interest rates kind of mystifying.
Totally. It's one thing to know what it means when they say interest rate. It's a whole other to know what to actually do with that information.
Exactly.
So, interest rates 101, let's start there. What exactly are interest rates? And like, why should we even care?
So basically, an interest rate, it's the cost of borrowing money or the return you get when you save or invest. CIRO actually breaks down some of the key interest rates. Like there's the policy interest rate.
Oh, yeah, that's the one the Bank of Canada sets, right? The one that's always in the headlines.
Exactly. It's like the benchmark. It influences all the other interest rates we see. And then there's the prime rate.
Okay, and that one is.
That's the one banks use as their baseline, especially for lending to, their most trustworthy customers, the ones with good credit.
So, like, if the Bank of Canada raises that policy rate.
Then the commercial banks, they usually follow suit,
Right.
increase their prime rates too.
Ah, so it's like a domino effect.
Exactly. And that makes stuff like loans, lines of credit, all that more expensive for everyone.
Okay, that makes sense. So before we jump into how all this affects things like mortgages or like investing, let's talk about how the interest is actually calculated. Because CIRO mentions simple versus compound interest.
Right.
And that's where things can get, well, impactful.
Yeah, for sure. So simple interest is, well, it's simple. It's only calculated on what you originally borrow or invest. Say you loan someone $100 at a 5% annual simple interest rate.
Okay.
They'd owe you $5 in interest by the end of the year. Pretty
The
straightforward.
compound interest, that's where it gets interesting.
Exactly. It's like interest on your interest. Say you've got $1,000 invested at, let's say, a 5% interest rate compounded annually. So at the end of the first year, you'd have 1050, right? But then in year two, you're earning interest on that 1050, not just the initial 1,000.
Oh, wow. So it just keeps building on itself.
Yeah, and over time,
Mhm.
especially long term, that can really add up.
That's awesome when you're earning it. Probably a little less fun when you're the one paying it on a loan, though.
Definitely, yeah. That's why really understanding how both simple and compound interest work is super important.
For sure.
It can make a huge difference in the long run for your finances. Doesn't matter if we're talking savings accounts, loans, investments. You've got to know how the interest is being calculated.
Absolutely, yeah. Couldn't agree more. Okay, so we've covered like what the different types of interest rates and the how that interest is actually calculated, but how does this actually like play out in real life for our listeners?
Yeah, so the CIRO source breaks it down into three main areas:
Okay.
borrowing costs, what you earn on your savings, and then investment returns. Those are the big
Yeah.
ones.
Okay, well, let's start with something I think we can all relate to. Mortgages.
Right, because borrowing costs in general, those are hugely impacted by interest rates.
For sure.
But yeah, when you get into mortgages, it's that whole fixed versus variable rate decision. That's where things get really interesting.
Because with a fixed rate, you're basically locking in a certain rate
Exactly.
for a set period of time. So it doesn't even matter what those market rates are doing, your payments stay the same.
Exactly. So even if rates go up after you've, locked in your mortgage, your payments are still the same. But of course, the opposite is true too.
Yeah, if they go down, you're kind of stuck.
Exactly. You're stuck with that rate you locked in.
It's all about, I guess, do you want the certainty or do you want to kind of gamble a little bit?
Yeah, exactly. Risk versus reward, right?
Right, exactly. Speaking of loans, though, I feel like a lot of people listening probably have student loans.
Oh, yeah, for sure.
And the source mentioned that the federal student loan interest rates, those are tied to market rates.
Yeah, so how that usually plays out
What does
is
that even mean?
when market rates are low, then those federal student loan rates, they're going to be lower too,
Okay.
which is great for borrowers, obviously.
Yeah.
But then when those market rates rise, which we've seen lately, those loan repayments, they can get a lot more expensive.
Oh, so it can go both
It
ways.
can definitely go both ways.
It's like a roller coaster a little bit. You got to kind of be prepared for the ups and downs.
Yeah.
But it sounds like whether it's a mortgage or it's student loans, you've really got to have a plan for managing that debt.
Absolutely. Having a budget, exploring your options,
Mm-hmm.
maybe debt consolidation. Those are all good things to think about.
Okay, so that's all about paying interest. What about earning it? how do interest rates affect, just our regular savings?
Right, because, yeah, it's easy to focus on the negative
Yeah.
when you're talking about debt and all that, but there's also the potential to actually earn more interest when those rates go up.
Okay, yeah, because CRO mentioned that when rates rise, financial institutions, they often have to offer higher rates, right?
They do.
On things like savings accounts and GICs.
Exactly. They want to
Yeah.
stay competitive.
Right.
So, yeah, your money, it has the potential to grow more quickly in a higher interest rate environment.
So that's actually good news for savers in a way.
To an extent, it is.
Yeah.
But, and this is a big but, we always have to remember inflation.
Right, because we can't just focus on the interest rate itself.
Exactly. Exactly. Got to look at the bigger picture. You could be earning, a decent interest rate on your savings, but if inflation's going crazy, your money's not going as far as it used to.
So it's like a race.
It really is,
Your
yeah.
savings have to outrun inflation.
They do. If you want your money to, maintain its purchasing power.
Wow. Okay. And then beyond just savings accounts, there's like the whole investment world,
Right.
which can feel a little overwhelming.
It definitely can.
We're talking GICs, stocks, bonds. CIRO mentions them all. It's a lot. Where do we even begin with that?
Let's take it one step at a time, just like the source does. We can break it down by investment type.
Okay, sounds like a plan. Let's do it. Okay, so we were in the middle of talking about how different investments, how they react when interest rates start going up or down.
Yeah.
And we started talking about GICs a little.
Right, right. So with GICs, you're basically locking in that rate of return
Right.
for a certain amount of time.
Yeah.
So when rates are going up, GICs, they can seem a lot more attractive because, well, you're locking in that rate that might be higher than what you'd get, down the line.
So it's like you're kind of trying to time the market, but
Yeah.
you've got that guaranteed return.
Yeah, you could say that. Understanding where those rates are going, that can definitely give you an advantage.
So are there strategies for that, for making the most of it?
Oh, yeah, for sure. There's one that's actually pretty common. It's called GIC laddering. So rather than putting all your money into one single GIC with, one maturity date, you spread it out
Okay.
across different GICs, different terms.
Yeah.
That way you can take advantage of those higher rates as each one matures.
Oh, that's interesting. Okay, so that's GICs. What about the stock market, though?
Ah, the stock market.
Because that feels like a whole other...
It is a whole other beast. It's not always as simple, cause and effect.
Right.
But generally when those rates go up, it gets more expensive for companies to borrow money,
Right.
which can eat into their profits.
And that, of course, affects the stock price.
Exactly. Investors, they're always looking ahead, right?
Yeah.
Trying to anticipate those profits. So if it looks like profits might go down, people get nervous.
They start to sell.
Yeah. And it's not just about company profits either. If rates go up, other investments like bonds, those can become more appealing to investors too.
Okay. Yeah, because if you can get a better return elsewhere,
Exactly.
why not?
So that can actually lead to like a shift of money.
Out of the stock market.
Yeah, people move their money around.
Interesting. Okay, so bonds.
Yeah,
They seem to be a big part of this whole puzzle.
they're a big player, that's for sure. One key thing to keep in mind is that bond prices and interest rates, they usually move in opposite directions.
Oh, interesting. How so?
So let's say interest rates are rising. Existing bonds, the ones with those lower rates that were set earlier, those are suddenly a lot less attractive to investors.
Because you could get a better rate with a new bond.
Exactly. Why buy something that's giving you a 3% return when there's a brand new bond offering 4%?
Right, right. But then that means...
It gets tricky, yeah, because if you need to sell that older bond, the one with the lower rate, you might have to sell it for less than you paid.
Oh, because nobody wants it.
Exactly. It's about making it appealing, even though it's got that lower rate.
Wow. So it's not enough to just know the interest rate. You have to kind of
You got to see the whole picture.
think about how it's all connected.
Right. And CRO, they really emphasize that. It's not just about, individual things going up or down. Interest rates, they're really a reflection of the bigger economic picture.
Okay, so we've been talking about these specific examples, but how do interest rates reflect the economy as a whole?
Well, they're like a signal. They tell us if the economy is healthy or maybe not so healthy and where it might be going. Central banks, like the Bank of Canada here, they use interest rates to try to keep things stable.
Okay, so break that down for me. I'm 5. If rates are doing this, what does that usually mean for the economy?
Okay, so simplified version. When the economy is growing really fast, like red hot and prices are going up, that's inflation, central banks, they usually raise interest rates.
To kind of cool things down a bit.
Exactly. because higher rates, they can discourage borrowing and spending, which should, in theory, help bring inflation down a little.
Okay.
But then, on the flip side, if the economy is slowing down, inflation's low, then they might lower interest rates to encourage people to borrow, spend, invest, kind of give things a little boost.
So it's all about finding that balance.
It's a balancing act, for sure, and it's complicated.
Yeah, there's a lot to keep track of.
There is, but even understanding the basics can make a big difference. Knowing how it all works, how it affects your finances, that's what empowers you to make those smart decisions.
Yeah, you don't have to be like an economist or anything.
Exactly.
Just got to be informed.
Exactly. Do your research. Ask your financial advisor questions. Be proactive.
Love it. Okay, well, we covered a lot today. Everything from how interest is calculated, simple versus compound, never forget, to how interest rates can affect your mortgage, your savings account, investments.
It's all connected.
And we even touched on the big picture, how it all fits into the economy as a whole.
And how understanding all those connections can really help you make those smart money moves.
Exactly. It's been great having you on, as always. And listeners, thanks for joining us on the Deep Dive.